All right, it's showtime. Hi, folks. Our topic for this workshop today is what is tactical investing? And the reason, in my opinion, why this is such an important topic is because there is an extremely important concept about investing that I don't think most people, even lots of financial professionals, understand. And that is that even though you may have a very good performing portfolio, it quite possibly could be better if you could control the volatility of it more. This is exactly what we intend to discuss and demonstrate to you in this workshop. What you will discover through this is that when the volatility of a portfolio is mitigated, when compared to other portfolios that have the same average returns, the lower volatility portfolio will always produce a higher compounded dollar return. And the main objective to the tactical method of investing is to lower the volatility of a portfolio and thus cause it to have a smoother have smoother returns than other forms of investing that do not place an emphasis on controlling volatility. With that said, that is exactly why I'm always so excited to discuss this topic in our workshops. Because, folks, we believe so much in this type of investing, and also because of the fact that the stock and bond markets have experienced so much volatility over these last couple years. Also, because so many people these days have been wondering if their portfolios are really invested in the best ways that they can be, especially when it comes to protecting from major losses related to major downturns in the market. Well, if that's you, then you're going to really enjoy this webinar today. Not only are we going to unfold the concept of tactical investing, but we're also going to show you what a side-by-side comparison between portfolios that have been invested using the tactical method of investing versus one that has not. Okay, folks, I hope that you can tell that we have a really special workshop planned for you today, one that we really think is going to be educational and enlightening for you. With that said, I want to thank each of you for attending today. Our topic, like I said, is what is tactical investing? My name is Brian Dougherty of PLC Financial Solutions. I'm your regular host for it tonight, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel. She will be the moderator for it, as always. She will also be handling all the comments and questions in our comment and Q&A boxes as we move along. Also, before we get started, let's take care of some general housekeeping first. First, if the screen is not big enough for you to read or see the images good enough, you can click on the View Options drop-down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One called Chat, it's for your comments, and another called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Another thing, you can also email your questions into us at info@plcfs.com if you find it easy to do while watching the presentation. Third, I'm sure that many of you have questions about this material we will be covering today. But since we have a good bit of material to cover and only an hour to cover it, I'm going to ask you again to put your comments and questions in those boxes below or in an email for us. And at the end, we will be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link at the end for you to do so. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention and because we want you to have fun as well, before we answer any questions, we have a 6-question quiz for you as always. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of their choice for each question that they get right. So make sure you have that handy dandy notebook handy to jot down some brief notes related to some of this very special bullet points that I'll be pointing out as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and we only transact business in states where we are properly registered or excluded or exempted from registration requirements. Also, SEC registration is not endorsement of the firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit and loss. So now that we got that out of the way, I have one for you as usual. Why did the tomato blush? Because it saw the salad dressing. You remember that one, Rachel? Rachel gave that one to me a couple weeks ago or a few weeks ago, and I jotted it down just for this webinar. All right, let's get started. So, first off, why is it a good idea to place the emphasis of your portfolio on minimizing volatility versus trying to maximize your returns? And why has using a tactical investing approach proved to be more reliable when it is all said and done for that? Well, it's simply because the truth about financial markets is that they are totally unpredictable. As you can see here, when it comes to the yield on 10-year Treasury notes from 2018 through 2021, as an example, you can see in this slide that it was all over the place and completely unpredictable because every single one of these lines in each of these time segments represents a different expert's prediction on what the 10-year Treasury notes returns would be for that given year. So that's a lot of predictions from a lot of different experts. Obviously, this demonstrates that no one really knows what's going to happen in the future when it comes to financial markets. To further make the point of how unpredictable markets are, let's look at this chart of the S&P 500 from 1990 to the year 2000. The average annual return was 18.16% for that decade. So because of this, what do you think that most people would have predicted for the market moving forward into the first decade of the millennium? Now, if your first thought is that it would be the skyrocketing returns that were the same as these, you're not alone. So let's take a look. Well, it didn't go as most people would have thought it was going to. What you can see is that from the year 2000 to the end of 2009, the average annual return was actually slightly negative. It actually ended at negative 0.95%. This, of course, demonstrates again how markets are completely unpredictable and how volatile they can be as well. With that said, please don't let anyone tell you otherwise when it comes to market returns. And if they do, you must realize that they are just speculating or guessing, regardless of their education or credentials. So With this perspective of the markets in mind, I hope you can now better understand why investing in a way that will minimize this type of volatility is a good idea, and thus why we believe that tactical investing, as well as other types of investing like protected investing, which both aim to reduce volatility in our opinion, are the way of the future. Okay. Now let's discuss another reason why tactical investing has become a more viable consideration when it comes to investing. In this slide, it compares the performance between the average investors, which includes all professionals as well, and the most common benchmarks that represent what we call the stock and bond markets in the US today, which is the S&P 500 index for stocks, also known as the equities market for most investors, and the Bloomberg Barclays US Aggregate Index for bonds, which is sometimes referred to as the AG by most investors. As you can see, the average investors consistently underperform when compared to these benchmarks. For equities, the underperformance on average has been roughly about 1.5% annually, and for bonds, by as much as 2.73% less annually. This, along with major market volatility, are the main reasons why most investors are unable to reach the performance needs and goals that they set for themselves over time. So here's a pretty funny looking slide. But what it represents is another reason why most investors' portfolios are unable to perform as well as the average institutional investor. And that's because people have a finite amount of time to reach their goals, while institutions do not. They don't have any timeline where they're going to need to use their money. This is a big deal. If we could all just leave our money sit forever in the market has historically proved to outperform most other types of investments. All right, so let's talk about another reason to manage losses or volatility in your portfolios. In this slide, there are two examples of what type of rebound returns it will take if a portfolio takes a certain amount of loss at any given time. It's showing this under two circumstances. The first, in the green columns, is with a portfolio that is not being withdrawn from. And the second, in the yellow columns, is with one that is being withdrawn from at a rate of 6% annually. As you can see from the first set of columns all the way on the left, a 10% market decline will require the green column with no withdrawals to have an 11.1% increase returned to get back to even, and the yellow column will need that's being withdrawn from would need a 19.1% increase return to get back to even. So obviously, the greater the market decline, the greater the increased returns will have to be in order to get back to even again. This is one of the most compelling reasons that you want to do everything you can to minimize drawdowns or volatility in your portfolio. When you get all the way out to the end, you can see that if there was a 66.7% loss, it takes a 66.7% gain to make up for a 40% downturn in a portfolio that is not being withdrawn from. And it takes an 85.2% return to make up for that same 40% market drawdown or decline with it being drawn down. So this is an awful lot for a portfolio to have to make up when it's experiencing that kind of volatility. All right, let's talk about why we believe that traditional asset allocation models just don't work anymore. But first, let me give you a little background on what are known as traditional or static, passive, or even long-only asset allocation models. So they're all basically the same with just different terminology for them. And where this investment concept or methodology came from. It stems from what's known as the efficient frontier portfolio theory that was introduced by Nobel laureate Harry Markowitz in 1952 and has since become the cornerstone of what is known in finance as the bullet point one. Come on, get out those handy dandy notebooks. Write this down. This is known as modern portfolio theory. Modern portfolio theory, or also for short, MPT. Write it down. Okay. MPT suggests that a conservative investor can do better by choosing a mix of low risk and riskier investments than by going entirely with a low risk with all low risk choices. At its heart, modern portfolio theory makes and supports two key arguments. The first is that a portfolio's total risk return profile is more important than the risk return profile of any individual investment. And two is that by understanding this, it is possible for an investor to build a diversified portfolio of multiple assets to optimize the risk-return ratio or portfolio, also called portfolio, or profile, as we call it. So, when you look at this chart, it starts by plotting the 100% bond portfolio or allocation, as it starts pointing out right here. Starts by that 100% bonds. That portfolio is plotted here. So when you look at the chart, so at that point, it shows that if you're willing to risk the loss of roughly around 9.7% of your portfolio, that's where this falls in, about 9.7%, where the risk is. You could get a potential return of roughly 5.9% annually. See, 5.9% across. There's the return. That's a 100% bond portfolio. Then what happens is actually totally surprising. As stocks are mixed into the portfolio at different percentages, the rate of risk actually begins to decrease as the potential return starts to increase. So that's, you see, each of these little dots represents more stocks being entered into the portfolio. And this is the risk. It actually starts to go backwards. It gets less risky as you're adding stocks. Okay. So by adding stocks to the mix, the risk actually goes down at first, not up. I'll tell you, I have to hand it to this Harry Markowitz for figuring this out, because I don't think anybody would have believed that before this. And then, as the percentage of stocks, which is represented by, like I said, each one of these little dots moving upward, it's added to the portfolio, you can see that the percentage of risk, which is represented by the x-axis on the bottom and moves from left to right, actually starts to decrease And even though it doesn't say it on this graph, when it peaks furthest to the left, that represents roughly a 25% stock, 75% bond allocation mix in the portfolio right here where it peaks. So it's at this point where the return potential is roughly around 9.9%, when the risk actually bottoms out at roughly 8.1%. So you can see it's up here around 9.9, just under 10, and the risk is about 8.1. So that's where it has the most potential for risk and the most potential for return and the least amount of risk. It's at this asset allocation, like I said, roughly 25% equity, 75% bond, where the portfolio provides the most return for the least amount of risk. However, when you go further up the line, as the curve bends back toward the right, Markowitz discovered that at the 60% stock, 40% bond allocation ratio or profile, that the portfolio would provide the most return with no extra risk than the 100% bond portfolio originally encountered. So this is the 100% bond, and this is right at the same risk level, but the potential return is over 12% there. So it was considered at that time in 1952 to be the most efficient or optimal portfolio. And this gave birth to what was known today as modern portfolio theory. And this chart of plotted portfolio asset allocations as the efficient frontier, which is still used today to determine what mix of investments will create the most efficient portfolios. Remember, folks, this was originally based on just bond and stock market conditions in 1952. What we need to know now is if the most efficient portfolio of that time is still the most efficient portfolio with today's market conditions applied to it. Let's take a look at that. Now, as you can see, the chart looks much different today based on how these different asset allocation models are performing now. You can now see that at the same risk level, the return has reduced considerably, and that there is not much more return to be had by increasing the risk considerably. Plus, the portfolio that is the most efficient, or was the most efficient, no longer, before in 1954, no longer has the 60% stock, 40% bond allocation, and is only producing slightly higher returns than the 100% bond portfolio in this slide. So this is it right here. This outright proves not only that the 60% stock, 40% bond asset allocation ratio is no longer the most efficient portfolio, but that when we plot that asset allocation today, see the blue circle inside the box that says 60% stock, 40% bond right over here. This circle here represents the 60-40. It doesn't even make it onto the efficient frontier curve that makes up the most efficient progression of asset allocations that lead to today's most efficient portfolio, which is more like a 30% stock, 70% bond mix right here. Moreover, what this chart is also showing us is that the traditional static / long only portfolio investment model in general is no longer the best method of investing to maximize returns for a given level of risk, because the additional potential return increases so little as the risk or stock allocations keep increasing. Even up to 100% stock allocation, which is the red circle furthest to the right here, and is showing that in order to have a chance at reaching a roughly 11% return right here, the portfolio needs to risk roughly 14.5% of itself, as compared to a 30% stock, 70% bond portfolio, which is the blue one here, to have a chance, or portfolio, which only risks roughly 8.5% of the portfolio to have a chance of getting a 10% return. Certainly, we can agree that it probably is not worth risking an additional 4.5% of the portfolio in order to make only 1% more. So, what this is telling us is that the traditional static or passive asset allocation portfolio that most of the big money managers still use today are no longer providing us with the most return for the least amount of risk. And they are no longer the most efficient portfolios or asset allocations to invest in. With that said, this is exactly why other investment methodologies like the tactical and protected methods have become more useful to many money managers today in lieu of this traditional asset allocation investment method, which was once the status quo for investing across the board and is still being used most commonly in the investment industry today. All right. So with all of the evidence pointing towards the fact that investment returns cannot be predicted in any consistent, reliable way, especially with today's market conditions, it's our belief that a philosophy that prioritizes managing the risk of a portfolio over the returns, at the same time positioning it in a way that has shown favorable returns historically, is the best approach towards asset management today. Now, our approach toward accomplishing this is by partnering with third-party money managers like Redwood when it comes to tactical investing, and Zega Financial when it comes to protected investing, both of which are investment methodologies that aim to reduce market volatility and provide comparable returns to the market. So, since this workshop is based on us breaking down tactical investing, let's discuss more what the approach of tactical investing is. So, in a nutshell, tactical investing is active investment management through the use of algorithms that tactically trigger shifts in the portfolio from higher risk investments like equities to lower risk investments like bonds, cash, and cash equivalents, whenever the market and economic data fed into the algorithms dictates these trades to occur. The object to this is to remove all human emotions and errors from the equation and to allow for these shifts from higher risk investments to lower risk ones and vice versa to start before the markets reach their lowest lows and their highest highs, thus mitigating the volatility of the portfolio substantially in most cases. Okay, folks. So I think it's very important to point out during this workshop that one of the most important philosophical distinctions between Redwood, who's a third-party money manager that we work with at our firm, and most other investment managers out there today, is that their whole approach towards investing is built on the foundation of managing the expectations of their clients. They have a three-step process for this. The first is to set client expectations for their portfolio performance that are not only appropriate, but also are more predictable and controllable. The second, then, is to implement investments that are designed to achieve those expectations. And the third is to give our clients curated materials and tools to measure that success. The whole reason behind this, because is because since it's their belief and mine as well, that portfolio performance can not be predicted, as well as controlling the volatility can be. However, by strictly adhering to this process, it has been proved out time and again that the returns, especially compounded dollar returns, have more times than not outperformed not only what the average investor can achieve, but many times even the market benchmarks have done as well. We'll talk more about that soon in the next few slides. Okay, so when it comes to step one, which is to set expectations for clients of the three-step process, we do this by explaining to the client how the portfolio model that we have determined would work best for their needs and goals has built into its name the actual target range it should perform within. The words that describe that are, bullet point two, I snuck up on you, didn't I? We went a while for another bullet point, sneaking up on you. Bullet point two, write this down. Write it down. The words or the actual two letters that describe the word in the name is DT. DT. It actually says DT. Do you see it here? Engineer risk budget DT 5 to 8, or DT 8 to 12, or DT 12 to 17. DT stands for drawdown target. So right in the name, you know the drawdown target. And that means that it's not going to draw down, that the goal for it is for it to not draw down more than 5 to 8% in any given 6 month period of time. Also, when you get all the way to the bottom, that means that it wouldn't draw down. This is their more risky portfolio, their most risky portfolio. It wouldn't draw down. It shouldn't draw down in the average 6 month period any more than 25 to 35%. So as you can see in this slide, under where it says Redwood Engineer Budget Portfolios in brown, each model portfolio has been given a max drawdown target. The first model is called the Engineer Risk Budget 5 to 8, DT 5 to 8, because it has an expectation to have a max drawdown of no more than 5 to 8%, 95% of the time with any given 6 month period. And you can also see here how each model has it there after its individual range based on how it is allocated. So it's this way that our clients can understand how to measure whether their portfolio is on track to meet its goals or not. Now, with that said, so when our clients see their portfolios draw down below these designated ranges, that's how they know that it's time to discuss with us what the potential course of action to correct the situation is. And as you can see, the portfolios start between the max drawdown of 5 and 8 and end at 25 and 35% range. What's great about this is that it is a very objective way to determine whether things are on track with a portfolio or not. One last thing when it comes to each portfolio, they are created in a way so that each portfolio can be matched to the risk tolerance of each individual client situation. So the EBR DT 5-day or engineer risk budgeted drawdown target 5-day will be for clients that have situations that merit a low risk tolerance. And as you move to the right, each portfolio can be matched with clients who have higher and higher risk tolerance situations. Again, these risk budgets are all very easy concepts for clients to understand, which give them a greater feeling of security when it comes to them. All right, now let's look at the second tool related to step 1 of the process that Redwood gives us to track the progress of each portfolio. In this slide, you can see to the right of the 3 rings that represent the process we discussed is not only the names of each model portfolio, but even more importantly, below the names is what is known as the risk-reward profile for each model. And what determines it is the 6-month 95% probability scale that is assessed inside a special risk measuring software program called Riskalyze. Well, it actually was called Riskalyze when this slide was created. It's actually now been rebranded with the name of oxygen, nitrogen. This risk-reward profile represents the portfolio return range that the portfolio can be expected to have 95% of the time in any given 6-month period under normal market conditions. And it's what is used to determine whether the model portfolio is within the max drawdown ranges that it's allocated to be within. So not only are clients told what the max drawdown goals are for the portfolio model, but we are also given a special software program that Redwood does not have any interest in financially to use to measure whether the portfolio model is on track or not. Okay, now that we're starting to get a pretty good idea of what tactical investing is in these Redwood portfolios and what they're all about, I think that we're ready for the secret sauce of them all that Redwood uses. All right, folks, up to this point, we've discussed all the things that we believe don't work, or at least don't work anymore, i.e. the 60-40 passive / static investing methodology, and why. And we've talked about how tactical investing works and the philosophy behind it, as well as the processes and the tools that we, through our partnership with Redwood, offer. But we haven't discussed the exact investment tactics and strategies that are used to deliver portfolios that can mitigate volatility enough for them to have a major positive impact on the overall investment performance of the portfolio. Bullet point 3 and 4. This is bullet point 3 and 4. Write it down. What Redwood does, and this is their special sauce, if you will, is they actually combine both a traditional static / long only portfolio, which they refer to as a strategic portfolio. That's bullet point 1. A strategic portfolio with a fully bullet point 4. What did I say? 1. Bullet point 3 was a strategic portfolio. Bullet point 4 is a fully tactical portfolio. Write them down. Strategic portfolio, tactical portfolio. They combine the two. And they call this special sauce in the name of each portfolio model, believe it or not, bullet point 5, like all in this one little paragraph. You got bullet point 3, 4, and 5. They call that special sauce an engineered risk budgeted portfolio. An engineered risk budgeted portfolio model. Or for short, you can write this down for short, an ERB. An ERB. That's what they call the special sauce when they combine the two different kinds of strategies. The strategic portfolio with the tactical portfolio. You see, that's what they're doing in this slide as they're overlapping. And that creates the engineered budgeted risk. It sounds quite simple, but each portfolio is also layered with 6 different fixed income allocations and 7 different equity allocations that get very specialized as well. We're not going to dig into that too much today, but because it would just take way too long for that. But I can assure you that they are extremely sophisticated and certainly worthy of a master's degree in finance. Believe me, I've sat through every single monthly portfolio update meeting, and it is hard to keep up with the level of thought and sophistication that they have put into these portfolios. But that's not why they have delivered the results. But that is actually why they've delivered such really good results since 2011. So let's explore how that works. Okay, so this slide breaks down exactly how the special sauce works. The strategic and the tactical parts of the portfolio models work in conjunction with each other to capture what neither could do on their own. This slide demonstrates what I mean from left to right. Furthest to the right, you can see that the image looks almost like a ski slope that we see at most ski resorts. This represents how an investment portfolio that is invested using purely what is known as long only or set it and forget it investment method. You can see that it experiences the full highs and the full lows of whatever happens in the market. You can also see that the major pro to this is that the assets stay invested at all times in order to capture all market rallies to their fullest. However, the major con to it is that it will also incur the full market drawdowns when the market is in crisis. Now, the middle image represents how a portfolio that was invested using purely the tactical investment method. The major pro to it would be that it would substantially reduce portfolio drawdowns by moving into more defensive positions prior to market crises. Okay, so in the image furthest to the right, it's here where the secret sauce that Redwood uses is displayed. What they do is invest the portfolio in 2 different parts, where one part is strategically invested and the other is tactically invested. And what this does is enhance the major pros and mitigates the major cons that each methodology experiences, thus allowing for the best of both worlds. All right, now that you all have a better understanding of how our firm, in partnership with Redwood, works when it comes to investment strategies, let's take a look at how it has played out in real life and what kind of results these things have delivered. All right, so in this real life example, it is showing how the ERB, Engineer Risk Budget, 25-35 portfolio has performed next to this 80% equity, 20% bond traditional portfolio, static or passive, if you will, portfolio. So at the top of this slide, you can see 3 circles, all with different colors and shades of colors in them. These all represent the engineer risk budgeted drawdown 25 to 35% Redwood model portfolio on 3 different dates, starting on February 19th, 2020, then on March 18th, 2020, and then finally on March 31st, 2020. Also below these circles is the actual loss, which was 21.66%, and the gain, which was 4.45%, that a $100,000 portfolio of this type incurred during that time frame. Now, I think that you all probably recognize those dates because they were how this portfolio was invested in terms of asset allocation just prior to when the bottom fell out of the market at the beginning of the coronavirus breakout in the US, and how it recovered within the next several weeks after. Now, below the Redwood portfolio, where it says index blend of 80% S&P / 20% ag, is an example of what the loss, which was 27.38% to be exact, and gain, which was a positive 11.97%, of the average purely static / passive or strategic portfolio that was invested in an 80% equity, 20% bond portfolio over that same time frame. As you can see, the Redwood portfolio was down less and up less as well. However, what you can't see is what the actual numbers were as it relates to these lows and highs. That is what those big giant question marks stand for. Now, I think that most people would intuitively think that since the Redwood portfolio only came back up to 4.45%, or by 4.5%, that it could not have had ended up with as much assets in it as compared to the 80-20 portfolio, because it came up to almost 3 times higher in terms of the percentage of increase. But I think that most people would be surprised to see what those percentage decreases and increases actually produce in real dollars. So let's take a look. We're unveiling. So here you can see in this slide where those big question marks were. You can now see the actual numbers that were produced by these losses and gains. And as you can see that the Redwood portfolio actually produced more assets, or what we call compounded return, or actual dollar return, than the average 80-20% static / passive / strategically invested portfolio. Bullet point 6, all the way to the right. You see it? I actually put it on the slide. Bullet point 6, final one. Actual dollar returns are more important than average numeric returns. Can you see it? Actual dollar returns are more important than average numeric return. And so, I think you can see why our firm prefers to implement the tactical investment method done through a quality third-party money manager like Redwood into many of our clients' portfolios. Because you can see here, even though the Redwood portfolio only came back up 4.45, because it went down 6% less, it actually was able to produce more money, over $500 more in that same time period. What, 1/3 of the amount of positive return increase. Amazing, right? Okay, folks. Now let's wrap this thing up. Well, that concludes the educational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone that is attending it. I want to offer everyone here with us a no-obligation complimentary investment plan analysis. And I want to take a minute to explain a little about what that entails and what you can get out of it. So this is what it entails. First, there's 2 ways we can actually meet to do it. First is to outline is online using Zoom, which is almost just like we are doing this webinar, but instead we'll both be able to see and hear each other, and it will be completely private. Second, we can meet in person at our office in Fort Washington, PA, just off the turnpike. I mean, people do that now, even though it seems like ever since the pandemic, this has become the status quo, which I'm okay with. Second, in doing so, we would meet it's a 2-step process. We'd have to meet first to gather all information that I would need to do the analysis. Then second, we would meet again to go over the results of it. Finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to integrate one of the low volatility tactical investing strategies that we discussed today, or perhaps even some other recommended adjustments if they can benefit you in your current financial plan. So if you'd like to take me up on this, Rachel will be posting in the comment box a link to a 60-minute meeting for you to do so. You got that on there, Rach? All you have to do is click on that link during our 6-question quiz or our Q&A session, and you'll be able to schedule a time at your convenience directly on my calendar today. Now, if you have any questions that you'd like answered before you book, you can also schedule a brief 15-minute Q&A phone call with me to do that as well. She'll also be putting up a second 15-minute Q&A meeting link as well. Also, we will be leaving this Zoom meeting open for a half hour after it ends today, so that if you would like extra time to be able to copy and paste any of the information or these links that we posted in the comment box or Q&A box, you have plenty of time to do so. Okay, that's it, folks. Now let's jump into our 6-question quiz and our Q&A session. And refer to the quiz and comment box for questions. All right. First question. What finance theory did Nobel laureate Harry Markowitz give us in 1952? MPT, modern portfolio. Good job, Patsy. You were right behind her too, Ann. Second question. What are the 2 letters that are built right into the names of all the Redwood portfolio models? And what do they stand for? The 2, DT, good one, Ann. And what do they stand for? No, a little tricky, right? Come on, you got this. I'll give you a drawdown target. That's right, Ann. Good bonus on that. I'm gonna have to increase that one from like $10 gift card to a 12 or something. All right, third question. Name one of the two types of portfolio methods that are combined in each Redwood portfolio. Name one of the two types of portfolio methods that are combined in each Redwood portfolio. Strategic. Good job, Ann. Okay, we're jumping on the other side of that. Name number 4. Name the other type of portfolio method that is combined in each Redwood portfolio. Tactical. Good job, Patsy. You writing these down? Also, let us know where you want your gift card to. All right. 5th question. What is the special description? This one's a little wordy. What is the special description and/or its acronym in the name of Redwood's portfolio models that refers to the special sauce or investment process that each portfolio implements in order to participate more in market rallies and less in market crisis? What is that description or acronym? Engineer risk budget, ERB, both got it. Good job. Patsy jumped on that quick. And final question. I don't know how anybody could get this one wrong. 6. What is more important than average rates of return? What is more important than average rates of return or average numeric rates of return? Remember, in that last slide, what is more important than average numerical rates of return? I'll give you his hint, right? What's that stand for? Give me the money. Actual dollar return. Good job, man. All right, that was a good one, man. I was stepping it up on these, right, Rach? All right. Let's see if we have any questions. Checking the email too. What do you got there for me, Rach? I can't hear you. Put your mic on. Yep, it's on. Hold on. I could hear you first. Let's see. Can't hear you. No. All right. Well, let me check in the email. Oh, I do see a few. Okay, good. All right, let's look at this first one. Now, if I'm already getting good returns from a 60-40 passive portfolio, then why should I change to a tactical portfolio? Well, that's a good question. Why should you? I think we just did a whole webinar on it, a whole webinar, but I'm going to answer it anyway. It's quite possible. It's not to say that you actually can't get solid returns with a 60-40 passive portfolio, especially if it's done right. I mean, I think Vanguard proves it all the time. What I can say about it is that I'm almost certain that when it's passive, that since it will be experiencing the full highs and the full lows of the investments that are in it, in that ratio, that is quite likely, if it was using more of a tactical, and that 60-40 is considered like a moderately aggressive portfolio, not aggressive, not moderate, which is like 50% equities, 50% stock. So in a tactically or low volatility based portfolio that was targeted for the same level of risk, it would be quite likely that, since the lows would be lower, that you could actually either get the same kind of return with much less potential for loss, or even slightly more return with a lot less loss at any given time. So it's not to say 60-40 can't still perform. It's just that at any given time, and of course, markets are about scenarios, right? Worst case scenarios, especially. So you want to be able to have the confidence and feeling in a worst case scenario, like, suddenly you end up in the hospital and you need half your assets, right? And the market's down like 2008, that you're going to lose a lot less money, but you can still feel confident that even though it's protected like that, that when it comes up, you're still gaining a comparable amount, if not more. So that's why I would say it's not that you can't do well in a 60-40 passive or strategic. It's that it's my experience that you can be in a better situation and have a smoother ride and do as good, if not better, in a tactically or low volatility or protected way of investing. That's my experience. So I don't know if I got that across right. All right. So we have another question here. How do I determine if my tactical portfolio is getting a better return than my old passive portfolio? Well, once you take the money from that investment and move it to another, you really won't be able to. You really need to have two portfolios side by side with basically the same amount of assets during a certain period of time. And you could actually see which one has more money in it at the end. And that's really the only way to do it. Because they could be showing, the one could be showing, like in that scenario, 11 or almost 12% return, when yours could be showing less than 5, but you actually have more money. So you have to be comparing the two different portfolios next to each other. So that's the way it has to be done. Now, you have another question. How do I invest in a Redwood portfolio? Well, that's a very good question, because Redwood can only be invested in through a third-party advisor. You can't actually call Redwood yourself and actually go directly into their portfolio. And the reason for that is because they acquire massive amount of their assets through third-party advisors. So they have a loyalty to them to offer them only through them. Final question. Will tactically invested portfolios not lose money in years where the market is down? Well, that's a good question. It's possible that they could not lose money when the market is down, say, slightly. So let's say it's down 2% on the year. Well, it's possible that that tactical invested portfolio of comparable risk tolerance may be up 2%, 3%, 4%, something like that. But if it's a big year where the market's down, say, like 20%, it's unlikely that that portfolio won't be down as well. It's just it will be down less, like in the example we showed. So like I said, if it was down 20, it's likely that portfolio might be down 14, somewhere around there. So, and then it's also the same on the flip side of that. On the up years, when the market's up like 20%, it's not going to be up 20%. It's going to be up maybe 13, maybe 12, something like that. But that differential from saving it from going down, that extra 6 or 7%, can make 12 on the upside just as effective as 20 is, as we saw. And that's what I like about, well, one of the things I like, and I think many clients like about investing in with a tactical approach. All right, well, that concludes the educational part. Oh, I already did that. What am I doing? I already did that. Let's see. All right, folks, that concludes our workshop for today. I just want to thank each one who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about important topics like this. I truly commend you for that, especially since the Go Phillies game is on. And I don't know if it started yet or not, but I'm dying to get in there too. So, on behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, say bye, Rachel, and myself, even though we can't hear you for some reason, she got laryngitis of the computer. And myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area. I want to remind you that if there's anything we've discussed tonight, or anything else for that matter, that you would like to discuss further with us, you can reach us at either 215-804-9708 by phone or by email at info@plcfs.com. Or to make it even easier, just go to our website at plcfs.com, and all our information is always there. Also, please mark Tuesday, November 28, 2023 at 7 p.m. on your calendar for our next webinar. Remember, we do them on the last Tuesday of every month, except for this month because it was Halloween. And have a great Halloween and Thanksgiving. And we will see you next month. Good night, folks.